Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Friday, May 3rd, 2024. It is 12:47 p.m. Eastern Time as I'm starting the video, and my pool school is officially over. I know pretty much everything there is to know about pool heaters and pool chillers and saltwater chlorine generator systems, titanium cells. Goodness. Okay. Anywho, so sorry for the distraction earlier today. So I'm back at my desk now, and wanted to here's what we're going to do in this video. It won't be super long, but I'm going to cover the main asset classes. Those are stocks, bonds, and commodities. I'm going to start out here with the equity markets. I've got a lot of posts out to you before I was, had to step away from my desk this morning. And I saw a comment. I'm going to reply to it here in the video. I've been very, very clear on this, but I'll repeat it. It's no big deal. These are good questions for weeks now that my plan was to, and again, when I say my plan, remember, I'm in and out, I micromanage positions. I'm talking a generic trading plan, and that's to add to shorts, or be net short or add to shorts on bounce back to resistance. And especially if I've covered at the, dips, like when we hit T2, under but not above 433, and we're slightly above 433. I also made clear that, at that point, I don't think it's objective to add shorts. So, like I said before, Apple reported in a reply to a comment, makes sense to lighten up, which I've done. So I'm waiting to add back. And so what I'm waiting for is a reversal back down below it. Now, I will say we are at, I'm going to get to it in a second, the comparable resistance. We haven't entered the trading zone on NQ, the Nasdaq futures. In fact, we stopped exactly there today. It was the first back test. I'll get to that in just one second. But again, I look at it this way. As I said before, it'd be net bullish if we take back 433. Again, it's where I had the line. You can see I had another line a little above 433.77. But what we do have for the first time in a while is positive divergence. First time since that post-Fed high where we shorted that post-Fed rally, waited it out, waited to the next day, gapped up there. Same kind of enthusiasm we have, almost exactly the same kind of move up percentage terms that we have from Apple earnings. And we know what happened there. I would say, and it bears repeating, the initial reaction to an FOMC meeting or a big market moving earnings report is often not the lasting reaction. It can be, it doesn't mean it can't be, and it's always going to be faded. But again, quite often those moves are faded. So you kind of have to wait till the dust settles. And that usually takes at least a full trading day, if not a few trading days. So here we are. So we're kind of in what I call no man's land. It's still not to the point where I would consider scaling out of the shorts that I have. I'm also having actually a very profitable day, even having index shorts, because of course I have other things that I'm going to talk about those. And these are the same things I've been throwing out there lately: commodities and treasury bonds and other things, although closed the treasuries today. That's it. And so we have, and this is where things really start to the odds start going down quickly. If we first of all, it would be ideal today to see us lose some of these gains and close back down on, or especially below 433, because then what's going to happen? We're looking at a 60-minute chart right here. We go to the daily chart, click over here. Here's what it looks like. This is today's candle. See how I have to scroll in? You hear me say this often. If you have to squint, look closely to see if a support or resistance level has been taken out, give it the benefit of the doubt. It hasn't. So what you have here is there's our trading range, our February to April trading range. There's a breakdown. There was backtest number 1. And as of now, we're in there, but the day is not over. So we're just, mere basis points, fraction of percentage from closing back down on or below, which would mean just another test of that resistance level from below. Now, next week, we start moving up. You could see on the 60-minute chart, I had the downtrend line. We start taking that out. Then that's a pretty big level. And in my opinion, that's going to significantly increase the odds that we're going to punch up to and probably out above the highs. So that's where I would be concerned about scaling out or hedging back up, possibly. More likely just scaling out. But that hasn't happened yet. So the day is young. I have as much convictions as I've had before that we're going to go on to hit these targets here. It's just a matter of how we're going to get there. I'll give this market points for holding up, but like I said, I factor sentiment in, and like I said, 5 minutes of CNBC this morning, and wow, the bullishness is so tangible and thick you could cut it with a knife. And so that is, from a contrarian point of view, well, that is contrarian from that point of view. It's funny, when the headlines hit yesterday, right after Apple reported, in my email, my inbox, I got 2 headlines. First was from the Journal, immediately, news alert, Apple sales fall as iPhone and China business remains sluggish. Apple revenue declined for the 5th time in the past 6 quarters, dragged down by ailing iPhone sales. As we all know, iPhones are kind of, they have services picking up. You've got Apple TV now. I don't know if anyone listens to their music. I mean, obviously some people do. Spotify is probably still the big leader there in the streaming music. But the big thing they know is iPhones, because you're captive to their to their app store and everything else. So this kind of drives almost everything in Apple. And of course, they whispered, Cook did little teasers with AI, which we knew he would do. They're supposed to announce whatever that is they're working on at the, I forget the acronym for their upcoming tech event. And of course, this is big, but they just keep getting bigger and bigger. So this is what Apple's resorted to, is more and more share buyback. So basically what you're looking at, guys, I don't have a chart pulled up here, but, I remember being in business school back in college, they talk about the life cycle of companies. You have that, startup, growth companies, which Apple was for many years, and then you start to mature, and then you plateau, and then you're just a cash cow. That's what Apple is at this point in time. The growth is out of it, but again, as I said earlier, it's still priced as a growth stock, yet it is a value stock. It has a lot of cash, more than it knows what to do with, so it keeps buying its stock back. But that really, at some point, and again, that may happen sooner, it may happen later. The market, if this trend continues, declining revenue, the market will price it as such and take out that growth multiple. Stocks that and you already see that with Tesla. That already happened to Tesla. And then the next, right after that, immediately after that email, then this one, Apple stock jumps on better than feared earnings report and huge buyback. So, and again, better than feared. So if that was feared, why wasn't it in the consensus? But I already talked on that earlier. It's the consensus. They beat a consensus, which they always do because they manage consensus. So anyways, kind of almost a dichotomy of headlines there. One being net bullish, one being net bearish. All right, so that's it. Let's not overanalyze this. Let's see where we finish the day, and let's see, most importantly, how Apple in the market trades next week. Like I said, we're just testing resistance. I still have a lot of recent sell signals that are still intact, meaning we're below those breakdown levels. All the top sectors of the S&P 500, the PPO in bearish territory on the weekly chart of all the indexes, QQQ, SPY, all of them, and that's that. So I don't want to spend too much time there, but I told you I'd go to NQ and look at that. This is the trading range on NQ, which I put a high weighting on both NQ and QQQ. Like I said, with Q being up, the Q's being above 433, it's kind of like hold off, sit tight with what I've got, and wait for the rejection. What's the difference? Wait for another 2%. If we drop 2%, we're back below 433, and then I can always add to it there, and it shows that we broke but couldn't hold it, and it was a false attempt to regain that level. But when you look at NQ, these are the levels, and it's super well defined, even much better defined on NQ. These are the futures, and a very, very impulsive breakdown from the range. And again, as I mentioned last week when we got there, we did have divergence. That's when QQQ first tested 433 right here, and it did get rejected, and so did NQ off that minor resistance there. And so now this is the first and only back test of the range from below at 18. I have the line, and I've had it here since long before we broke below it at 18.046. You can go back on all of my other charts. Today's high was, let me see, pop up 18. I checked, I think it was 18.050. Yeah, 18.050. You're talking 4 points on an 18,046 point index. That is virtually a perfect hit. Now, does it guarantee we're going to stop there? No, but we did stop there so far. You go down to a 1 minute chart today, and you can see that was the high right there, and so far we pulled back. It's a line chart. Go back to candles. That's it right there. So there's that tag at 1850. And again, it's not victory yet unless we reverse. But I just wanted to reiterate my plan and, sitting tight there. Now let's talk about the other things. First, I'm going to talk about something that I was harping on quite a bit last year. If you were here in 2023, especially towards the end, I created this chart here. I call it it's a negative feedback loop, or you can call it the inflation doom loop, is what I like to refer to it as well. And you can see very clearly, so what happens is lower rates, expected or actual. So what did we see recently? What did we do? We went long Treasury bonds in expectation of a bounce. I listed the 30-year bond as both a pure play, if you want to just go long bonds, even if you're not short the market, or also a hedge. Told you that's what I did. Took enough to hedge up and it worked out. So what happens? Rates fell. What happened to stocks? They rallied, right? And that's the rally we hit off T2. Perfect tag of the T2 level on QQQ. I'm talking the daily chart, second target. And but then what happens? So once stocks start to rally, and there's a bit of a lag there normally. Let me give you a darker arrow color so you can see it. So what you'll see is stocks then start to rally, and then after that, commodities will begin to follow. Why? Because if the stock market is rallying, right or wrong, and in this case I believe wrong, but right or wrong, that is market participants' expectations of future economic growth. They think the market's, that's what ultimately, fundamentally, in the long run, will drive the stock market up and down, right? The economic cycle. Good earnings means economic growth, right? The companies are making money. Bad earnings, economy goes down, you go into a correction or a recession. And so what happens is this rally, you're going to start to see, and we are seeing commodities start to follow. So the stocks go up, but then so do commodities. Rising commodity prices then equate to inflation, causing interest rates to go up again and causing stocks to fall. So that's the loop that I believe, that I know we've been in. I'm going to show it to you. I talked about it quite a bit last year, and I think that's still very much in play. So let's go over to this chart here. And let's overlay DJP as a broad-based commodity ETN I've covered in the past. You can use, there's others out there. You can use any one you want. And so this was the commodity, or what I call commodity, or commodities I use because they're measured in real time. It's just, guys, the easiest way to measure inflation, the only way actually to measure inflation in real time. I mean, tick by tick, minute by minute, because crude oil, which is by far the biggest component there, natural gas, even agricultural commodities, industrial metals, they all trade on the exchanges, and many of those are trading 24/7 via the futures. And so unlike things that are in the CPI and the cause inflation, real estate, we can't, that data is very lagged and dated by the time you get it. So this is what I say we use as real-time inflation. So, okay, we all know what happened. COVID hit. Governments responded with the nuclear option, fiscal monetary stimulus. It set the stock market on fire. By the way, SPY is in green, the S&P 500. DJP, which is a broad-based UBS commodity index, in white. They both rocketed up. Powell was dismissive of inflation, saying it was transitory. The Fed was clueless until they pulled a pivot around here somewhere in the market. And they were listening, those market participants, same one listening to the Fed now, were going along with it until right here it started to matter. So this is when the S&P 500 peaked, exactly in the beginning of 2022, right there. The Nasdaq peaked a little earlier back here. And what you could see is, so all these rising, finally the market started to realize, hey, maybe Powell doesn't know what he's talking about here. This inflation thing, it's real. I'm starting to feel it. I'm starting to go to the grocery store, and milk and eggs and the gas I'm putting in my car and everything I'm buying is going up. And so we all know what happened. This is the stock market, right? Okay, that's history. Commodity prices continue to go. They peaked here. Now, the damage was already done, so the big correction came. Again, start of probably the first leg down to bear market. Then commodities started to abate, and the market loved it. It screamed up. That first drop, you see it there, That's not mere coincidence, guys. It is not. I was talking about this back then. Okay, so market ripped up, but then nope, another rally in commodities. Oh no, 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 that's not good for the stock market. But then at this point, a trend emerged. See, that's what happened. Look at the white line again, commodities. You can see at that point we made a lower high and then a lower low, and that's when the market said, "Oh, guess what? The Fed won. All these rate hikes. They pivoted. They pulled a 180. They hiked the crap out of interest rates." And great. And so remember, that was back in last year, Powell's what everyone calls his mission accomplished speech. And so the stock market loved it. But guess what happened? Let's fast forward. Okay. Last year, we had a pretty healthy correction starting last August. And why did that happen? Was it random? No, because commodities started going up. And that was the biggest counter trend bounce. We had a nice rally in commodities. The stock market didn't like it. Then, okay, it's okay. Commodities down, crude oil has been abating, and we got this final leg up. So that's where we are now. And again, the S&P 500 sees there was this little blip back up. We just had this correction that we traded. Remember, we made 8% so far, hitting T2 on our QQQ short. We reversed it there, got another few percentage points, and so that's what happened is we had that correction. I'm using SPY here. QQQ fell more, and that was because this was the biggest leg up in inflation, biggest rally in commodities since then. Okay, you cannot argue that. That is not. I'm showing you the levels. You can go back on the chart. What you can argue and take the other side of me is where we're going to go from here. So that's what we're going to get into in this video next. And then at the end, I'll touch lightly on bonds. I already gave you my thought there. So I just want to impress upon the importance that this is going to be where I'm going to be doing this for at least the foreseeable future. I don't know if that's all of 2024, well into 2025. I believe we'll be in this sticky inflationary environment. There's going to be great rallies to trade in the stock market and in commodities, and there's going to be corrections in both the trade. And there's going to be times where the commodities will be moving up and the stock market might dismiss it. Again, it takes the market and people a while to recognize a trend. What's the difference between just a blip? This is a downtrend with little blips, and then you start to get a trend. And again, you can see, let me just show you here, a trend is typically defined as a security making higher highs and higher lows. You got a trend there, and that's when the stock market started to take note. This so far is a trend, and the $1 million question, are we going to get this? And that's what I'm going to get to in a second. If we get that, we're going to get this in the stock market. Okay? Remember, this is the stock market in green. This is commodities. Okay, hopefully that's clear. Now let's take a look at commodities. I'm going to go over just, the ones that I'm in now, and I've been highlighting hopefully some of you are in my favorites. And we'll start out with wheat. Wheat's not going to move the needle like crude oil. I'm going to get to crude oil here. But again, this is, it's been a nice day so far in this one. We rallied up. We hit T1 recently. Drew some arrows just like this. When we hit it, drew a little pullback arrow. And that's what I think will happen to, arrow breaks are where you're likely to get reactions at each target. So you can see wheat moving up. Nothing goes up forever. The pullbacks, to me, aren't random. It happened right at T1, almost to the button right there. Same thing with wheat futures. And again, this is as much an update on an existing trade as it is analysis for the stock market as far as inflation goes. And again, commodities do matter. Just know that a 10% or 20% move in crude is going to be priced in much faster to inflation because it makes its way to the pumps much quicker than does rising grain prices. They're not going to the Pillsbury Doughboy isn't going to raise the price of a roll of cinnamon biscuits or a loaf of bread if wheat jumps up 20%. They can absorb that cost and wait to pass it along unless that trend is persistent and continues. But we hit that. I've had here forever and a day these targets here, and today we hit that again. This was the T1, comparable to the T1 level, and I wanted to say this: the fact that we already hit it once and had the pullback. That's why I list multiple targets. It's upon the initial tag of each target that a reaction's likely. Now, sometimes you do. It's still resistance until taken out. So it doesn't guarantee we're going to punch through there. But what it does do is it diminishes the odds, in my opinion, that we're going to stop there this time around. In other words, it increases the odds that we can punch through T1 because we already hit it once and we already had a reaction, a little reaction today, and that's normal. But unlike then, where I turned around and closed it, T1 to buy back at a lower price, like I told you I would do. This time around, I'm not. I'm going to come in next week, and I think there's a better chance that we're going to pop above there than there's a better chance that we're going to get rejected again. No guarantees. I'm just sharing you my thoughts and how I'm trading. So I added on corn and soybeans recently. Corn, perfect tag. Well, punched through it a little bit on T1 today, but there you can see the reaction. Again, this is where you could have took a quick profit. I didn't. I'm holding on to my grains for now. I think we'll probably punch on through here next week, if I'm correct, whether we pull back. If we do, if you want to get in, obviously any pullbacks, because this was a big breakout to me. Remember, I was waiting for a break above 2022. We got it yesterday. There was your breakout buy signal of this trading range. And so, if we get a pullback to it, that's subjective. Anything much below, maybe another back test of the trend line. That's certainly possible. These grains have been grinding around, but I wouldn't, I'd favor that we're going to continue on through here soon. And then, you won't hear about this right away. And CNBC doesn't talk about grains unless they talked about wheat when it was going through the moon when Ukraine got invaded by Russia. Other than that, you're not going to hear about these much, but it's something to keep on your radar. And more so, to me, it's a way to be diversified. So on a day that my index shorts are down, the grains are up, my natural gas is up, my treasuries were up, close those out at the highs. And so that's diversification. That's what I try to preach all the time. Don't put all your eggs in one basket and spread it among different asset classes and uncorrelated securities. So there's corn. The other one was soybeans, SOYB. Also up today, continuing on, breakout backtest, impulsive move yesterday. Got it right before I got it out to you, right after I got it out to you. This is ZC, the futures, for you futures traders. Remember, that was the level on the futures I wanted to see, and that was my first target, 469. It's right there, perfect tag of that level, and a pullback to test the range. So this is why I see corn futures are already back testing. So they broke out, hit the first target, pulled back as expected, and should continue on to these other targets if my read is correct. And if it's not, look, if we come back in the trading range, there is a midpoint level there that's there's some support we could catch, but you probably go back to the bottom of the range. And if you go below the bottom of the range, you can exit out any of these levels, use stops, and then you can always get back in later if it firms up. I'll say wheat, has had a couple fits and starts this year where it looked like it was going to get going and it didn't. But this time, like I said, the case is even stronger now on all these charts. And then SOY or ZS. ZS soybean futures just hit that 211.25 target today. There's the breakout of the downtrend line, the breakout above the 191.75 resistance level, and that just couldn't look better. Doesn't guarantee it'll hold. If it pulls back, you get a back test of 190, 192, give or take. That'd be an objective entry or re-entry or add-on if you get a back test of the trend line. Anything other than that, it fails. You still have really good support down here, but it's not a good sign when a breakout fails. So you might want to hold off and see how it acts down here. I'll update it. I'll continue to update these guys because I'm pretty vested in this trade right now. All right, and then the next one is natural gas. Natural gas up over 5% today. Certainly looking good. Plus a breakout of this wedge I gave you. This is not a daily, but 8-hour candles. So 1 year price history. Big wedge. Remember, natural gas. This is also very long-term support. You don't see it here because I'm only going back a year, but I've showed it to you on the longer-term charts. And so we hit resistance. So two things happened today. We broke out of the downtrend line, but we hit resistance. We're at resistance right now, and you can see it's this whole basing pattern here. So If it can build on these gains, if it comes back to back test the trend line, that would give you an objective entry. Or if we break above pretty much today's highs and we can put a little real estate behind that, then it should be, again, on this longer term frame, smooth sailing to any or all of these targets. So natural gas still looking good, and again up 5%, which is 3 times what the market is, or 2.5 times what the Nasdaq is, and almost 5 times what the S&P is today up. Okay, Treasury bonds already updated to you this morning, or at least I told you, I removed that hedge to close my longs. And that was at 116, 112, perfect. We were in exactly at the lows, and so far, knock on wood, we'll see out at the top. I'm not shorting it. I want to say that. I drew arrows pulling back. I just removed it, just took off the hedges. If we go back there, that would be an objective short entry. We may go up and hit that downtrend line. I gave you a couple downtrend lines to target. There's that one. And then potentially that other one. You also have big resistance right here, so still a potential zone. But let me talk to you about rates, where we might be going. So let's look at the 10-year. The 10-year is the most important bond. I'll trade, I'll track the 10, but I trade the 30. Why do I do that? Same reason. I'll tend to either, I'll use gold futures at times, but I tend to often trade either silver and or GDX when I'm bullish on gold. Why? Because I'm either going to be right or wrong on my call or gold, and I'm going to get paid more on silver and GDX. If gold goes up X, GDX goes up a factor of X, usually 2, sometimes even more times that. Likewise, if I'm bearish on gold, GDX and silver are also silver tends to move in the same direction, just a higher percentage than gold. Same thing with the 10-year. You have just more duration, interest rate risk on a 30-year bond, but the 10-year is the one the financial markets watch. That's what the 30-year mortgages track to. So this is a weekly chart, and there's this is the 10-year Treasury yield. So peaked out back here. Had a big pullback, bonds rallied. We were in long treasuries. We used TLT at that point. I'll get to that in 1 second. And so we broke down from this beautiful uptrend line that was at abatement in interest rates, gave fuel to the stock market rally. But then we had this tick up back in rates here. And that was the catalyst to take us down into the bottom and below the bottom of the range in QQQ recently. So in other words, when we hit our T2 short. So this is, remember, these are yields or rates. Rates go up, that's inflationary, not good for the stock market. When rates go down, then that is good for the stock market. All other things being equal, and I put a big giant caveat or asterisk in there, saying that there can be points, and I expect there will be points in the foreseeable future where the stock market is getting pounded pretty hard. If we go down and we take out my T2 level that we just hit on QQQ recently, bounce there, and we go down to my next targets, T3, T4, where I favor right now, it's probably going to be pretty impulsive selling. It's going to wipe out everyone that bought Apple today and yesterday, and NVIDIA and all that. And you'll probably see a flight to safety into bonds with institutions selling stocks. So they won't understand what happened. How can Apple go down if they just announced the biggest stock buyback in the history of the world? Those are the things that are just kind of it's a paradigm. It's a WTF moment. So we're not there yet, guys. Look, I'm just telling you what ifs. I'm just telling you scenarios and how to react if it happens. But anywho, there's a little trend line here too, right here. I'm going to add. I was just drawing it out there. I just saw it with my eye. So what I had here and I'm leaving it here. So this was, obviously a very nice technical bearish setup, and again, we made a lot of money, or really nice trade, nailing the lows on when we had that drop in rates. We were long TLT, then we turned around, I had it as a short and to game the pullback. I'll get to TLT in a second. Now, so this says breakdown, a little snapback rally, and based on the measurement of the wedge, it says rates are probably going to go lower, and here's a really good target. However, there are things in this chart that tells me that we may get another push up. And I drew this line, and I shared this with you back a couple months ago. It's been a while since I updated this long-term chart. I can see the possibility because what's happening is everybody's getting on board with the direction rates are going. And I've been making some pretty contrary calls on rates when everyone thought they'd peaked. I said, nope, another thrust up. That was back here. And we did. We had new highs. Then everybody was saying, oh, we're going to 6% on the 10-year. Nope, we're going to rally. Rates are going to go down. And so it's a market has almost had it backwards. But then the stock market reacts. Now, here's where I'm going with this. We have the PPO has done a really good job. You can see it down here of defining the trends. And the PPO zero line, that is. This is your PPO, close cousin of the MACD. I use the 9 EMA, which is the signal line, the last of the two to cross. And you can see it's pretty clear. When you're below it, two things. Number one, the trend is bearish, right? Below it, bearish. Below it, bearish. Above it, bullish, vice versa, right? Below it, cross below there, stay below till right there, then you cross above. But not only that, that's one thing. It also acts as support and resistance. When you're below it, above it, once you break above, look right here, perfect back test, and you bounced. Then you crossed. There's a perfect back test. It held, and it kept the bullish trend intact, right? You cross there. You almost hit it from above. Here's a crossover. Oh, I'm sorry. Let me back up. There's your bullish crossover. Perfect back test. Again, the white line, the zero line. Another perfect back test. Another perfect back test. We're still above it. So, this trend, I'm talking this trend of higher rates that started right here by this one trend indicator remains, this at least remains bullish, this trend indicator. And we could bounce again. Now we could cross through. If we cross through, I just showed you where we're going, in my opinion. We're going to take out this uptrend line and go down to 3.33 on the 10-year, right? That's the yield. You just move the decimal over one. But other than that, trend right now says bullish. So I can see this scenario here because most market participants think this. If they didn't think it, they wouldn't be buying Apple right now. They wouldn't be buying QQQ today. So I can tell you most market participants, and that happened today, by the way, guys. If you don't know what happened, I mentioned it this morning, employment numbers missed by a mile, and they're calling it a Goldilocks scenario because the employment data came in much softer, well below consensus, and so they cheered it, rah, 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 that gives the Fed a reason to cut rates. And so rates are going to go down, and that's where bonds rally. That's why I sold into that rally. But that's where we could see a head fake here. So I just wanted to point that out. And then I told you I'd talk to y'all too. I don't want to spend too much time on it, but this is we were trading off the 60-minute chart. And just to recap, that's when that pullback in yields happened. We went long right here, nailed the bottom, hit T1, 2, 3, 4, got out there, turned around, shorted it down, hit T1, hit T2 recently, and then just at the lows there, at literally the day of the low, not the day of, the actual low, went long, closed it out today. And that's been the trades on bonds. So you can do those individually. And I know most don't. I never, I get, oh my God, the market goes up 1-2% and we get the trolls that come out. Or if it goes down, you get everyone happy that their QQQ trades making money. They bought some puts. I never get any feedback on these Treasury trades. You can make, some of the wealthiest traders in the world are bond traders. The thing about bonds, they're boring. They don't move up and down as much, but you can leverage up because of that. You can, if you have a margin account, you can leverage. They have leveraged ETFs for the bonds. I trade the futures, which are inherently leveraged. Your broker will give you more than enough rope to hang yourself. If you're trading futures, you can have a small account and, 100, probably less, 50, 100,000, trade millions of dollars of bonds. A nominal value via futures. So all I'm getting at, guys, I'm not encouraging you to use leverage or futures, but if you're trading bonds, it's not worth it if you're trading only TLT and you're buying the same amount you buy in Apple or a QQQ or SPY. You're going to have these whoopie-doo 3, 4, 5% trades. But if you get the direction right and then you're leveraged, you're not taking any more risk than you are by buying, a smaller amount of NVIDIA or Apple or Amazon or QQQ or SPY. I hope that makes sense. You've got a more volatile instrument. Your risk and reward is higher. And so you go with a less volatile instrument. But something like Treasuries, as I just outlined, is very tradable to the technicals. Very tradable. It behaves very well to these, support resistance, this little bullish falling wedge back there. So even, even as we were short, we hit T1, we had a bullish falling wedge, we got a rally. You could have took profits there, got back in, and you had a downtrend line. You had it again. You hit the bottom of the T1 zone. Remember, this was a zone. What'd you do? You broke out of a bullish falling wedge. You rallied again. Where'd you hit? Where'd you stop? At the downtrend line. And you go back down to the bottom of the T1 zone again. What'd you do? Rally back to the trend line. Then we went down. What happened when we broke T1 zone? As I talked about it at the time. Well, we went down my second target zone. Hit the top, bounced, then hit the bottom, been trading around it. So that's all. I'm just trying to impress upon the importance of, diversifying. And then, like I said, TLT, you can trade it standalone or Treasury bond futures, or you can also use it in conjunction, as was recently suggested, as a indirect hedge. If you, especially during earnings, this was a good time to be hedged, with all these big market moving reports, and it worked out well. All right, as I wrap up, I just remembered I didn't cover crude. I said I would. And I also didn't get to the UNG chart. My apologies. I tried to cover both the ETFs / ETNs as well as the futures. And so we're back here. Remember, nat gas has been basing recently. And we already hit, this is all the way back here. We broke out of this bullish falling wedge, hit T1, hit it again, almost hit it again. We're there now. So if we can pop that, we should open the door. I'll tell you what, since we've consolidated so much under here, we'll probably, in my opinion, we'll blast through T2. So I'm going to tell you right now. Now I'm also trading NG, the natural gas futures. So I'll use that chart. I already covered that with you. Either way, we could just move right on through T2 and head up to T3, T4 before we get much of a reaction there. So let me cover crude oil, and this one matters again more than any other thing. If you're only going to watch, well, you don't have to watch only one thing, but this is one of the things for that whole inflation trade. I started the video with the whole doom loop, if you want to call it, inflation loop. So what do I see in USO? I told you yesterday, along with Bitcoin, they're starting to look interesting, and Bitcoin is up. I'm not going to cover that in this video. It's certainly it's coming off that. I point out the positive divergence and was at mild support, and it's up nice today, about 4%. But I want to talk about crude oil in this one because keep focused in this video to just the asset classes. Actually, crypto is probably a new asset class. I probably should include that as a separate asset class in itself, cryptocurrencies. But you see this trend line here, comes off the December lows. We're not there yet. I think we're probably going to get there, and then I think that's going to be it. There's a downtrend line. I would really like to see, I may start scaling into crude today. We're at support. Sometimes if I see this move and I'm saying, okay, well, I think there's a good chance we'll bounce if and when we hit that trend line. But guess what? It's only another 2%, which for crude isn't much. Remember, with crude, just like natural gas, you beta adjust your position size. What does that mean? Again, if your number is different from everyone else's. If your number is 10,000 per trade in SPY, you don't put 10,000 in natural gas. You don't put 10,000 in crude. You put less because they're more volatile. If you're right on your call, you're going to make a lot more. They go up and down more in percentage terms. So take that down to whatever you're comfortable with. So yeah, that's pretty good support. I'm going to show it to you on futures in a second. This is decent support. I've got just a little bit. It's small divergence. And sometimes that's all it takes. Plus, we're quite oversold. And this is why I'll probably take a position here shortly, take it home for the weekend. I'm going to study a few more charts. I'm going to go over a couple with you right now. But either way, so that's it. That's about 2% down to there. And then a stop somewhat below. I'm looking at USO. I'm going to get to CL crude futures in just a second. And then so your buy points would be here down to, but not below right there, and or on a breakout above this downtrend line. So let's say we do go down a little more, or we don't. Either way, we break the trend line, we can head up there. Remember, it's that doom loop thing. Stocks are rallying today. So if the sky is not falling, then we don't have demand destruction. I think a lot of this, you think it was mere coincidence. I don't. I told you back here, you could short crude off this divergent high as also as an indirect hedge to the stock market. Why? because if the stock market rallied, and it did when we hit T2 on QQQ, it's rallied since then. And so what that does, it implies future economic growth. Hence, demand for, this is when the stock market was started to go down. We haven't seen we saw the bounce. I'm sorry. This is when the stock market started to fall, when post-Fed right there, and the stock market fell. And so what that implies, is where I was going, is demand destruction in crude. Now, there's other forces. Yes, I know things have settled down a bit in the Middle East for now, and that plays into it as well. But you see also the demand destruction. And first and foremost, to me, it's always fundamentals. I mean technicals, I'm sorry. Fundamentals, matter, and you can factor them in, but not so much for trading. You'll get clocked, clean clocked, if you are cold clocked if you try to trade crude on fundamentals, because you're reading a headline. By the time you read the headline, it's instantly priced in. You can't trade crude on fundamentals. At least I can. Technicals are going to be way more accurate. You got to get ahead of these moves. And so we broke down and rejected. And so we've seen this rally in the stock market, but no concurrent rally with crude yet. So there it is, guys. I like crude here, down to here, not below, and stops probably somewhere around there, a little bit below the trend line. Let me show you CL. CL are your crude futures. If that contract's too big for you, just like with natural gas, just like with the NQs I trade, and the ES and RTY, they have minis and micros. You can look those up. Google MCL, I think, is the mini crude. QM, if I'm not mistaken, is the micro. No, MCL is a micro, I think, and then QM mini. The micro is smaller, the mini contract, and they trade to the same technical level. So when I go over my CL chart, or on natural gas I think is QG for the mini, the mini contract. You guys can look it up, and it's same price levels. It just has a smaller multiplier. The multiplier is your leverage factor. You take the price of the whatever the futures is, multiply it by the multiplier, and that's how much in dollar amount you're trading. But here it is. We have some decent support we're coming up on right there. You've got you're starting to get some divergence forming here. One more thrust down to that trend line would be all the better. So that's what I like. Scale in from here. Not go to a full position until we either get here or something else convinces me. I don't keep it light right now because we're in a downtrend. So I don't, it's not enough technical evidence for me that it's a hard bottom right now. That's all I'm trying to say. So, but obviously I spent the whole first part of this video talking about the doom loop, and so I see the stock market rallying. I'm going to hold on to those shorts for the time being, and I'm going to build a little more into my commodities, because that's where if QQQ holds above 433 and starts moving up next week, let's say wants to run at that downtrend line that I gave you on QQQ, and then sooner or later you're probably going to see people stepping in and buying crude oil. It's kind of almost a risk-on trade, and it's that inflation trade. Where to? I haven't even really listed targets yet. I'm just looking. You can see one right here. That's 70, but that's a very shallow target. If we can get a trend reversal, downtrend line, you can just come off there that high, and that'd be one level there. And if that gets broken, we could even see higher crude prices. And remember, it's kind of an incremental thing. Same with Treasury bond yields. That takes me all the way back to something I haven't talked about in a while, but let's do it now, and then I'll wrap the video up. Okay, so this is where it was mentioned from here to here up to red zone, which was also resistance at $83, that previous reaction high. We had the negative divergences on the 60-minute chart. Then we broke the trendline support. So that was thrown out there as a indirect hedge to short crude if you're holding tight on swing shorts on the market. And so that paid out. So now we're back in the yellow zone. Remember, this is where the market started to take note and really take note. Remember that correction. We had that 8% drop off the highs on QQQ. We're still well below those highs. And what was that from? As predicted, we entered this orange zone where the market would really start to take note. This is where the market freaks out, just like my red zone on treasuries. And so that's what did it. We got the correction in stock so far, and we're still in the yellow zone. Yellow is caution. It means crude prices are still elevated to where they've been in recent years. This is USO. See, we're still up here where this is that sticky inflation thing. So the market, high-fived itself today on shitty unemployment numbers. That we're going to get a rate cut, but again, I think it's getting ahead of itself. And look, maybe not. If we get this, look at that beautiful uptrend line. What the equity bulls want to see is this, but as long as it's not via demand destruction, which we may get here soon. I'm seeing economic indicators, the ones I watch, the ones that I think are more reliable, continue to roll over. We even saw that with ISM services today. Bad number there too. That was at 10 a.m. And so the market is actually doing its bizarre world thing where it's rallying and applauding weak economic data in hopes it's going to get its next rate cut. Careful what you wish for there, market. All right, so there's USO. And then to wrap it up, we go back to IEF, and I have my zones there. Remember, this was it. Yellow zone, the market would start to take note of rising yields. Orange zone, we broke into the orange zone back here. That was in the beginning of April. And when did QQQ peak? QQQ peaked right here, but was starting to move lower. And when did QQQ start to waterfall? Right there. And that was mid-April. Was it mere coincidence that we entered in mid-April right here? We started really plunging way down into my orange zone where I predicted the stock market would really start to take note of rising yields. Nope. But then, had made the case, it was bullish divergences, breakout back tests, and look where we are right now. We rallied back. I gave you this target back a week or two ago, 92.76. Also a reason, why I'm out of the TLT trade. That's resistance. And it's also about the measured target of the wedge. You take the widest part of the wedge, which is right here, add that to where it breaks out, and that gives you a measured target. And that's about that. So if we see this, anything here, we come back down, we undercut that recent low, we're probably going to punch down in the red zone. We haven't done it yet. Right now, the yields are falling and bond prices are going up. But just watch this, and this will be, to me, it's not the be all end all, but it's a big determinant of where we're going to go in the stock market. And so again, if we get rejected here, or maybe we run up a little more, hit the top of the orange zone, which is resistance, 93.50. But if we get anywhere near this red zone, I still maintain the stock market will freak out, and that meshes with kind of my, the outlook I've had for weeks or months now that will go down on QQQ, hit T2, no reaction, little if any reaction I said on T1, hit T2, it was a gameable bounce. And then if we go back down soon, and it should be another, this was an impulsive move. It would be even more impulsive to get down to T4 and T5 if that happens. So, all right, we'll wrap it here. I don't think we're going to have any idea or much insight, if you will, to where the market's going to go. We're probably going to park, on or around 433. If there's a late day pump, they take it up to the trend line. We're still in the lower part of this range right here. Given that's a net bullish thing, and again, I would not be, me personally, even if I had no positions at all, I wouldn't be adding to any shorts unless we fall back below 433. That's it. If I need to pull the plug on these, which again we're recycled into back from here to here after going long off there, covering going long. So I'm still very positive, and nothing I could do now, if you count this, multiple entries here, would, even from the typical official swing trades on the site, we had a couple entries, one I think somewhere in here I did, it's not on this chart, it's on a different 60-minute chart where we had, this was it, one of those, that breakdown there as well, the back test, the post-Fed rally, and then the breakdown here. But again, it's, like I said, multiple entry points. I highlight these all the time. Objective entries, objective levels to cover and play bounces. So there's no one, it's not a binary trade. I've long since got away from doing those. Sometimes I do them where, one entry, one target, and that's it. But this has been a more complex trade, and rightfully so. Look where we're going. We're going nowhere. Bulls have gone nowhere for months. Bears have gone, not very far. It's just been one big sloppy sideways grind, and I think we've traded it just about as good as you could trade it off these levels. Okay, so I'll wrap it up here. You have the things to watch, and that's the main asset classes. And then, I'll continue to hunt for some new trade ideas. Like I said, I'm not reading too much into what's happening today till the day is over, and then it's a Friday, so you always have to, and then whatever you have today, you're taking home for the weekend. So we'll really I think we'll have a lot more color, more visibility on where this market's going to be headed from here after we pick up next week. If Monday they continue to build on these gains, take out that downtrend line, take out the midpoint of the range. I already gave you my thoughts. That's bullish. Otherwise, this could be a one-day wonder. And if by chance, and I think there's a decent chance, but if they fade this today, park it down on or below 433, then it's simply another back test. This candle is going to look different. You're going to have a skinny wick, and the fat body is going to be back right on resistance, just like it was right here. See that little doji parked right on 433 that day, pulled back. All right, guys, this has been Randy Finney with Right Side of the Chart, and have a great weekend.